Hey there, deep divers. Welcome back for another journey into making complex topics crystal clear. Today, we're unlocking some really specific, but honestly incredibly powerful insights into financial reporting. Think of it like gaining a superpower for understanding financial info, cutting straight through the jargon to the core. Our mission, as always, is to take a stack of information today, digging into these unique financial statements and engagements, and pull out those crucial nuggets of knowledge. We want you to walk away feeling truly well informed, without getting bogged down in every single detail. We're really here to explain every part in detail, make it easy to grasp.
And this deep dive is particularly vital. These aren't just obscure accounting terms. They're different lenses, really, through which you can view a company's financial health and future. We'll explore how they help us understand both very specific situations and bigger picture possibilities in the real world.
Okay, let's start with our first lens then, almost like a magnifying glass. We're going to unpack something called Agreed Upon Procedures, or AUP. What exactly is an AUP engagement, and, well, how is it fundamentally different from what most people picture as a typical financial audit?
Right. So an agreed upon procedures engagement, it's a specific type of attestation engagement, which in plain English just means a practitioner, like an accountant, is giving some assurance on a subject matter based on specific criteria. But here's the key difference. The practitioner performs only the specific tasks that they and the client have explicitly agreed upon. They do those agreed upon tasks, collect the facts, and then report just the findings. And crucially, they do not provide an overall opinion or a conclusion.
Right.
So unlike an audit where an auditor says, yep, this looks fair and accurate overall, with an AUP, it's more like you asked us to check X, Y, and Z, and here are the precise results of those checks. No judgment on the whole thing.
So it's like asking someone to confirm if a specific list of tasks was completed, like, did they really count all the widgets on shelf A, B, and C, rather than asking for their overall approval of the entire warehouse inventory process. That pinpoint focus is critical, right?
Exactly. That's spot on. The beauty of AUP is that the client or the engaging party, they're really in the driver's seat. They know precisely what information they need, and they're responsible for assessing whether the agreed-upon procedures are sufficient for their specific purpose. Sometimes, the party asking for the work isn't the party responsible for the subject matter itself, and that's an important distinction we have to note in the report.
Okay. This sounds incredibly focused. What are the key criteria then, or conditions that need to be in place for an AUP engagement to even be a possibility? It feels like there's a checklist of sorts that has to be met before you can even begin.
You're right. There's a definite framework. And actually, there's a great way to remember the 7 core conditions. It's the mnemonic, I am sure.
Oh, handy. Okay, let's hear it.
Right. So first, I is for independence of the practitioner. The professional doing the AUP, they must be independent, no conflicts of interest.
It makes sense.
Second, A is for agreement of the parties. The practitioner and client must clearly agree on the specific procedures, the criteria for evaluating findings, and any limits on what's material. Very specific, upfront agreement.
Okay, got it.
Third, M means measurability and consistency. The subject matter itself, it needs to be measurable. The procedure should consistently give you evidence, and that evidence has to actually exist.
Yeah.
You can do an AUP on, like, someone's opinion.
Right. Needs to be concrete.
Exactly. Fourth, S is for sufficiency of the procedures. And here's where the client responsibility comes in big time. They have to determine that the agreed-upon procedures are enough for their purpose. It's like if you only ask an inspector to check if the door is painted, you can't complain later if the roof leaks, because you didn't ask them to check the foundation, right?
Good analogy. Okay.
Fifth, U is for due. Use of the report could be general or restricted to specified parties, so flexibility in who sees it. Sixth, R covers a responsibility for the subject matter. Either the client is responsible for it, or they need to show evidence that a third party is. And finally, E is for engagements to perform agreed-upon procedures on prospective financial statements. If you're applying AUP to future-looking statements, we'll get to those. They must include a summary of significant assumptions.
I am curious. That's actually brilliant for remembering that checklist. Okay, so once these procedures are done, conditions met, what does the actual report look like? What are the absolute must-haves in that report? And maybe more importantly, what's not in it that someone used to a full audit might expect?
Yeah, good question. The AUP report is very structured, very precise, always in writing. You'll see a clear title, always including the word independent. It identifies who asked for the work, who's responsible for the subject matter, what the subject matter is, and the specific purpose. It explicitly states the subject matter is the responsible party's responsibility, and crucially, that the client acknowledged the procedures were appropriate for their purpose. And maybe most importantly, it includes this critical statement that the report may not be suitable for any other purpose. Users have to figure out if it's right for their needs.
Okay, that disclaimer seems really key.
It absolutely is. And the report will clearly state the engagement was not an examination or a review. Therefore, and this is the big one, no opinion or conclusion is expressed. This no opinion part is fundamental. The practitioner isn't vouching for the whole picture, just reporting on those specific checks they made. It then provides, usually like a bulleted list, of the specific procedures performed and the exact findings. Any exceptions found, they're listed too. That transparency is really its value. It also mentions the practitioner's independence and ethical requirements.
So that raises the question you touched on.
Mm-hmm.
If there's no opinion, what value does it really provide?
It's about getting those laser-focused, fact-based insights. If you're, say, a potential investor buying a specific piece of equipment from a company, maybe you don't need a full audit. You just need to know, did they really count all 10,000 units in Warehouse 7, and are they in good condition? And AUP cuts through the noise to give you that one precise answer.
Okay, that makes a lot of sense. So that magnifying glass, AUP, gives us pinpoint accuracy on specific details. But what if you're not looking backward at what was, but forward, at what could be? That's where our financial crystal ball comes in. Prospective financial statements, or PFS. How do these differ from the usual historical ones?
Yeah, a crystal ball is a good way to think about it, though maybe a slightly foggy one. Prospective financial statements are inherently forward-looking. They're based on projections and assumptions about what will happen or might happen, not reporting on past events. Right. Now, they can cover a period that's partially expired, but if the period is totally over, well, then they're not prospective anymore. And it's important to note, pro forma statements, which we'll get to in partial presentations, they are not considered prospective financial statements. Different category.
Fascinating. So we're talking about what might happen. How do you even put numbers to that? Are there different types of these forward-looking statements?
Yes, absolutely. Two main types, and the distinction is really crucial. First is a financial forecast. This reflects the expected financial results for a future period. It's based on what management anticipates under expected conditions and their planned actions. Think of it as a best estimate. Management's usually the responsible party here.
Okay, just estimate. Got it. What's the other type?
The second type is a financial projection. This is different because it's based on hypothetical assumptions. It's a what-if scenario. It shows what the financial position and results would be under a specific set of assumed conditions that might not actually happen.
Ah, okay. So a forecast is what we really think will happen, and a projection is more like what would happen if X, Y, and Z were true, even if we don't expect them to be. How are these used then, and by whom? Does the type dictate who gets to see it?
Precisely. And yes, their use is categorized either general use or limited use. General use means the statements are for parties not negotiating directly with the company. Think a broad group of potential investors, maybe. For general use, only financial forecasts are appropriate. You wouldn't give a what-if projection to just anyone.
Right, that could be misleading.
Exactly. Limited use, on the other hand, means the statements are for the responsible party themselves or for parties negotiating directly with the company, like a bank considering a loan, or maybe an investor looking at a specific deal. For limited use, both financial forecasts and financial projections are appropriate. That bank, for instance, might want to see both your expected forecasts and a what-if projection if, say, interest rates skyrocket.
That connects directly to the real world, doesn't it? If I'm that bank deciding on a loan, I'd want to see how the company expects to perform, sure, but also how they'd hold up if things get tough.
Exactly. You'd want that range of possibilities, the expected and the what-ifs. Mm-hmm. And practitioners, accountants, can get involved with these prospective statements in four main ways: preparation, compilation, examination, and coming full circle, agreed-upon procedures. But it's really vital to remember, a review of prospective financial statements is not allowed. That level of assurance just isn't considered appropriate for forward-looking info.
Okay, so 4 ways in, but no reviews. Let's walk through those 4 then, maybe starting with the less intensive ones. Preparation and compilation, what do those involve? What's the key difference for, the person using the statement?
Certainly. Let's start with preparation engagement. This is actually quite similar to preparing historical statements. You agree on the terms, understand the company's reporting framework, make sure there's a legend on each page saying their perspective. The main restriction is that the practitioner shouldn't prepare PFS that leave out a summary of significant assumptions or, for projections, don't state the hypothetical assumptions or limitations. It's basically assembling the numbers based on what the client gives you.
Okay, so putting it together, what about compilation?
Right. A compilation engagement for PFS is also about assembling the data based on the responsible party's assumptions. But critically, the practitioner provides no assurance. Zero. They don't say if the statements follow AICPA guidelines, the rulebook for presentation, or if the assumptions are even reasonable. They read the statements and assumptions, check for obvious inconsistencies or omissions, but they don't have to gather supporting evidence. They just need to be aware, like obviously inappropriate assumptions.
So really just putting it into the right format?
Pretty much. And independence isn't required for a compilation, but if the accountant isn't independent, they must say so in the report and explain why. The report itself identifies the statements, says management is responsible, mentions it was compiled according to standards called SRs, and clearly states no opinion, no conclusion, no assurance. Big caveat. Prospective results may not be achieved, and no duty to update.
Okay, so compilation is basically assembling it, no real checking behind the numbers. Very different from an examination, I imagine. Tell us about examinations. That sounds much more rigorous.
It is, yeah, much more rigorous. An examination engagement for prospective financial statements is substantially broader in scope and responsibility. Its main purpose is to express an opinion on two key things. One, do the statements conform to AICPA presentation guidelines? And two, do the underlying assumptions provide a reasonable basis for those prospective statements?
An opinion. Okay, that's a big step up.
Huge step. And unlike compilations, independence is absolutely required here, non-negotiable. The practitioner has to get sufficient evidence. They evaluate the preparation, the support for the assumptions, the whole presentation. The report from an examination will have independent in the title, and crucially, it gives that opinion yes on conformity with AICPA guidelines, yes on a reasonable basis for assumptions. It still includes those caveats, though. Results might not be achieved. No responsibility to update. And for projections, it has to identify the hypothetical assumptions, state the purpose, and include a paragraph restricting its use.
What if things aren't quite right? Can they modify the opinion?
Yes, absolutely. If AICPA guidelines aren't followed, or significant assumptions aren't disclosed, or the basis isn't reasonable, you might get a qualified or even an adverse opinion. If they can't get the evidence they need a scope limitation, they'd issue a disclaimer of opinion.
Wow, that really clarifies the spectrum. From just compiling numbers, no checking, to a full examination with an opinion on the assumptions themselves. So where does our old friend, agreed upon procedures, fit into this prospective world?
Right, back to AUP. Well, the general conditions and reporting elements, we talked about the I am sure checklist, they all still apply when doing AUP on prospective financial statements. But there's one extra condition specifically for AUP on PFS. The statements must include that summary of significant assumptions. Can't do it without that.
Yeah.
And the report has a few extra bits, too. It needs a disclaimer saying they're not giving an opinion on AICPA conformity or assumption reasonableness. It needs the caveat that prospective results might not happen, and the statement about having no responsibility to update. What's really fascinating here is just how much the level of assurance, the comfort you can take from the report, changes so dramatically across these different engagement types for prospective statements.
That's a great point. What about something called partial presentations? You mentioned them briefly. Sounds like maybe an incomplete picture.
That's exactly it. Partial presentations are prospective financial info bits that, well, they exclude certain essential elements you'd normally expect. Things like maybe sales or gross profit or net income or major changes in financial position. They're missing key pieces. Because they're incomplete, they're generally not appropriate for general use. They're mostly for limited use situations, and any report on them has to clearly describe what's missing, the limitations.
Okay, makes sense. Limited use for limited information. Now, finally, let's switch gears slightly. Put on our financial time machine, maybe, for pro forma financial statements. These sound a bit like prospective, but the source clearly says they're not prospective. What's the key distinction there, and why are they important?
This is a really crucial distinction, and yeah, it trips people up sometimes. Pro forma financial statements are designed to show the effect of a future or hypothetical event. But, and here's the key, by showing how it might have affected historical financial statements if that event had occurred earlier. So the critical difference is they start with historical data and then apply adjustments to it. They're not creating a purely forward-looking statement from scratch like prospective statements are.
Ah, so it's like saying, okay, if we had bought that company last year, here's what our 2023 income statement would have looked like then. It's recasting the past based on a hypothetical.
Precisely. You nailed it. It's recasting historical figures to reflect a what-if scenario for the past. And they absolutely must be clearly labeled as pro forma so nobody confuses them with the actual historical results. And here's another key difference from prospective statements. Pro forma financial statements can be examined or reviewed by a practitioner.
Okay, so examination and review are back on the table for pro formas. What does a practitioner actually do when they examine or review these, and what goes into their report?
Right. So the practitioner needs to really understand the event, the acquisition, the restructuring, whatever it is. They evaluate the pro forma adjustments, which are based on management's assumptions about how that event would have flowed through the historical numbers. They also get written representations from management. Their report has to reference the historical financial statements that the pro forma info is based on and state whether those historical statements were audited or reviewed. Then, for examination, the report expresses an opinion on whether management's assumptions provide a reasonable basis for the adjustments and if the adjustments reflect that basis properly. For a review, which is less scope, it provides a conclusion basically saying nothing came to their attention, suggesting the adjustments aren't appropriate. The report essentially helps you understand the potential impact of a significant event on a company's past performance as if it had happened then. Which really raises an important question, doesn't it? How does knowing all these distinctions empower you to critically evaluate financial information you come across?
So, wrapping this up, what does this all mean for you, our listener? We've really taken a deep dive today using like 3 different lenses. We started with that magnifying glass of agreed upon procedures, getting laser focused, fact-based insights on specific agreed upon checks, very precise. Then we peered into the crystal ball of prospective financial statements, understanding forecasts, best guess, versus projections, what if, and how examinations and compilations give different levels of comfort about future possibilities. And finally, we use that financial time machine, looking at pro forma statements to see how hypothetical events could have reshaped historical data.
Yeah, and throughout, we've seen how these different engagements offer vastly different levels of assurance. From simply reporting specific findings in an AUP with no opinion, all the way up to an examination of prospective statements, giving an opinion on the reasonableness of the underlying assumptions. Understanding these distinctions is just key to interpreting reports correctly and making informed decisions.
It really is a shortcut to being well-informed, isn't it?
Yeah.
It gives you the specific insights needed to understand, okay, what kind of assurance am I actually getting here? Or maybe, what assurance am I not getting? Allows you to ask much better questions.
Exactly. For you, the learner, this means you can look at a financial report any kind, really, and immediately grasp the context. Was this just a specific agreed-upon check? Is it someone's careful prediction of the future? Or is it a what-if scenario about the past? This knowledge helps you ask smarter questions and interpret the information much more accurately. You won't take a compilation report as seriously as an examination, for example.
Absolutely. And here's a final thought for you to mull over as we close out. The next time you encounter any financial information, whether it's looking backward or forward, actively think about what kind of assurance or process went into its creation. How might knowing the difference now between an examination, a review, a compilation, or an agreed upon procedure change how much weight you give to the numbers you're seeing? Something to ponder. Thank you so much for joining us on this deep dive. Until next time, keep digging for those nuggets of knowledge.